Hi, good evening. My name's King Brand, and I'd love to thank you. So now, as we look to go a little deeper into what we're talking about today in this amazing acquisition opportunity for Amazon acquiring Cipher Mining, my partners Andrew and David and I will walk you through everything that we see as an amazing and innovative opportunity for Amazon. So our agenda today will be starting with our introduction and executive summary, our strategic context and SWOT analysis, where we speak to you about the different synergies and amazing opportunities that we think will come from this amazing acquisition. We'll walk you through our analysis and calculations and assumptions of how we came up with some of these things and these amazing opportunities and synergies. And then we'll take you through the due diligence that we acquired and went through in order to figure out that this was the great piece that Amazon was missing. And finally, we'll wrap up with a Q&A session for you guys to ask all the questions that you have so we can address any concerns and let you know how amazing of an opportunity this is for Amazon, Cipher, and beyond. So let's go further. Now, listen, to get started, we just want to say that Amazon's acquisition of Cipher Mining represents a bold step into the future of digital infrastructure. Beyond e commerce and cloud dominance, this move positions Amazon at the forefront of blockchain and cryptocurrency innovation, not only by leveraging Cipher's mining expertise and renewable energy driven operations can Amazon diversify its revenue streams, but it also has the opportunity to revolutionize payments and revenue streams as we know them today by accessing innovative digital payments and stable coins, creating a competitive moat against all competition such as Google, Microsoft, and Meta. And most importantly, this acquisition aligns Amazon's long-term vision of building scalable, sustainable, and technology-driven platforms that redefine global commerce and financial ecosystem, setting Amazon miles ahead of the competition. So listen, why don't we get straight to it and start talking about some of the amazing strategic advantages and strategic synergies of Amazon acquiring Cypher. As we said, there's an amazing opportunity in cloud and infrastructure, but not only that, and also into entry into digital assets, as Amazon has the opportunity to expand AWS into blockchain as a service, enterprise blockchain validation and mining as a service, as well as dive into advanced computing to power AI and next gen workloads. Now, on the digital asset side, it allows Amazon a strategic foothold in crypto, which will be an amazing opportunity beyond just payments, but also allowing Amazon to create its own payment structure, revolutionizing the e commerce game. This also allows global expansion through AI driven data centers and new cloud monetization, along with amazing tax benefits that increase Amazon's revenue streams beyond what our wildest dreams could think of. Let's continue on. So listen, as we know, Cypher emphasizes renewable energy mining and supports Amazon's aggressive carbon neutrality and renewable energy commitments. So that moves us on to our energy and financial advantages of Amazon acquiring Cypher. So not only are we able to have energy and sustainability alignment, but we're also able to improve on our financial and competitive benefits, including diversification of revenue beyond e-commerce and AWS, and creating a competitive moat against Google, Microsoft, and Meta in the blockchain infrastructure. With this acquisition, Amazon would be able to have new mover and first mover advantage against its competitors and set the tone for all e-commerce and blockchain revenue moving forward. Now, listen, as the saying goes, with great risk comes great reward. So, we want to let you know we've done our due diligence to find out what are some of the risks that are associated with Amazon acquiring Cipher Mining. And we found out there are things like regulatory uncertainty, volatility risk, as well as reputational risks that are associated with this move. But that's because it's so innovative, that's because it's so powerful, and that's because it has so much potential. We've done our due diligence in evaluating Cipher Mining as well as the synergies that'll come along with this acquisition. And we believe that the risk greatly undersees the opportunity. and potential of this acquisition. And we think by walking you through our SWOT analysis as well as our calculations and assumptions, you'll be convinced as well. So let's go. So now let's move on to our SWOT analysis and take a look. As I said, our team at Brand, Boschik, and Gamble has done a great job of assessing the strengths, weaknesses, opportunities, and threats associated with this powerful acquisition. And we believe that the opportunity for success and the synergies aligned with this acquisition far outweigh any of the risks that are involved, especially with things like the big, beautiful bill that's coming into place. We know that the world is moving toward cryptocurrency. So AWS integration with blockchain services aligns with Amazon's sustainability goals and gives us, again, that early mover advantage in crypto, which far outweighs any exposure to crypto volatility and consumer reluctance to convert. Opportunities such as expansion into digital payments and stablecoins gives Amazon the opportunity for new revenue streams outside its core businesses, depreciation-based tax advantages, and again strengthens that competitive moat against its big tech rivals, which far outweighs any potential threats of reputational backlash or any technological disruption that's involved with crypto and fintech. As we said, cryptocurrency is the wave of the future. So why shouldn't Amazon be riding that?
To dive into our financial valuation, let's start with the key financial assumptions underlying our valuation model. We anchored our analysis using a risk-free rate of 4.5%, which aligns with the current 10-year U.S. Treasury yield, a solid baseline for long-term capital investments. The market risk premium is assumed at 6%, reflecting both broader equity market volatility and the growing uncertainty around the crypto-linked infrastructure. Given CIPHER's high exposure to crypto market cycles and energy volatility, we use a beta of 2.77 to capture the elevated risk profile. Finally, the tax rate is a set 21%, consistent with the U.S. corporate standard and reflecting Amazon's consolidated effective tax plan. Together, these assumptions create a realistic foundation for evaluating both CIPHER's standalone performance and the combined entity's post-synergy cash flows. Now moving on to our WACC, which represents the blended cost of financing the business. We calculated a cost of debt of 10%, factoring CIPHER's high borrowing costs due to its smaller scale and crypto exposure. The cost of equity came out to 21.12%, driven primarily by the elevated beta and risk premium from the prior slide. Combining these figures with the proportional weight of debt and equity in CIPHER's capital structure gives us a WACC of 20.67%. This is critical because the WACC essentially defines the hurdle rate. For a high-growth, high-volatility asset like CIPHER, that's a reasonable and honestly even a conservative bar for Amazon's risk adjustment expectations. Next, let's look at CIPHER's standalone valuation under the income approach. Using a terminal growth rate of 15%, which is in line with the broader blockchain infrastructure market, and our previously defined WACC, we projected CIPHER's future free cash flows through 2029. The forecast for sales growth, EBIT margins, depreciation and amortization, capital expenditures, and changes in net working capital are based on a blend of CIPHER's historical data and reasonable forward-looking estimates tied to its expansion plans. The resulting discounted cash flow yields an intrinsic share price of $10.59 compared to a current market price of $11.47. On a standalone basis, CIPHER appears fairly valued. That brings us directly to the impact of combining CIPHER's infrastructure with Amazon's ecosystem. Now, when we layer in the synergy-adjusted income approach, the picture changes. This scenario reflects the incremental free cash flow benefits that Amazon can unlock through integration. Specifically, in 2026, about $35 million in synergy value, primarily from shared energy procurement and hosting revenue expansion. In 2027, synergies rise to about $55 million as CIPHER's mining operations begin leveraging AWS cloud optimization and AI-based load balancing. By 2028, synergies reach $80 million, driven by scalable co-location and enterprise-level hosting clients. And in 2029, we project $100 million in synergy value as renewable energy and infrastructure integration mature. Factoring these into the DCF, we see the implied share price rise to $13.43, which is a clear indication that the acquisition becomes value accruing under Amazon's ownership. Beyond the numbers, these synergies represent a real strategic advantage. Finally, we conducted a sensitivity analysis to stress test both valuation models against different market conditions. For the standalone case, with terminal growth rate ranging from 12 to 19% and a WACC between 7 and 25%, the implied share price spans from $4 to $67, with a core value range of $9.90 to $15.38. In the synergy-adjusted case, the same growth and discount rate assumptions yield a range of $5.26 to $83.29, with a realistic inner band between $12.59 and $19.35. What this tells us is that even under conservative assumptions, the synergy case consistently outperforms, reinforcing that the strategic integration of CIPHER into Amazon's ecosystem doesn't just mitigate risk, but it amplifies return.
Starting with the market comps, CIPHER operates in a volatile space, Bitcoin mining, but the valuation fundamentals are crystal clear. On an EV to revenue basis, peers range from about a 2 to 36x, with a median roughly at 12.4x. CIPHER sits well within the band, trading around 37x, signaling the market already prices in its low-cost energy advantage. Now, look at EV to EBITDA, the real tell. The peer median lands around 19x, while CIPHER's multiple pushes 140x, inflated by its early growth curve and thin margins. Our takeaway for Amazon, CIPHER's valuation reflects optimism, not efficiency. The market's overpricing near-term performance, and that gives Amazon leverage. This is a classic setup for disciplined acquisition. We're not chasing hype. We're resetting valuation around operational reality. Starting with the market comps, CIPHER operates in a volatile space, Bitcoin mining, but the valuation fundamentals are crystal clear. On an EV, when we line CIPHER against peers, the story becomes clear. CIPHER's enterprise value of $5.9 billion versus $42 million in EBITDA looks pretty stretched, until you factor in its growth runway and energy economics. At the peer median EV to EBITDA of 120x, we arrive at an implied equity value of $4.95 billion, or just roughly $12.59 per share. That's our baseline. But here's the real play. The integration synergies, energy optimization, AWS level compute utilization, and hardware scaling. We model an uplift to $13 plus per share. That's value creation through Amazon scale and efficiency. So our message is this. Amazon isn't overpaying. We're unlocking an undervalued energy asset and converting it into a high margin compute platform. When we line CIPHER against peers, the story becomes clear. CIPHER's enterprise value of $5.9 billion versus $42 million in EBITDA looks pretty stretched, until you factor in its growth runway and energy economics. At the peer median EV to EBITDA of 120x, we arrive at an implied equity value of $4.95 billion, or just roughly $12.59 per share. That's our baseline. But here's the real play. The integration synergies, energy optimization, AWS level compute utilization, and hardware scaling. We model an uplift to $13 plus per share. That's value creation through Amazon scale and efficiency. So our message is this. Amazon isn't overpaying. We're unlocking an undervalued energy asset and converting it into a high margin compute platform. Here's the power of combination. We modeled the acquisition under 10, 20, and 30% premiums. And even at the high end, the deal stays EPS neutral to accretive. No new debt, no leverage strain, roughly 3/4 funded by Amazon's existing cash. Now look at the synergies. By deploying CIPHER's renewable energy sites into AWS compute and AI workloads, we capture incremental revenue without new CapEx. CIPHER's megawatt infrastructure effectively becomes a low-cost power hedge for Amazon's high-demand compute clusters. This isn't just about Bitcoin mining. It's about owning the underlying energy compute stack that fuels the next decade of cloud and AI. This is financially sound, strategically aligned, and operationally seamless. That's how we expand capacity while enhancing earnings. Now that's smart capital. Here's the power of combination. We modeled the acquisition under 10, 20, and 30% premium. Our diligence focus ensures every synergy we're modeling actually sticks. First, energy contracts and PPAs. CIPHER's renewable PPAs drives its cost hedge. We'll confirm transferability and change of control clauses, locking in that 10 to 15% cost advantage post-close. Second, tax assets. CIPHER's NOLs and depreciation schedules deliver $8 to $12 million in tax shields, real cash value to Amazon's bottom line once it's integrated. Third, technology and cybersecurity. CIPHER's data center systems will fold into AWS standards, airtight access controls, compliance, and encryption. Fixing gaps early avoids $10 to $20 million in remediation risk. Once secured, these pillars create the foundation for synergy realization. Energy, tax, and tech alignment. We protect Amazon's downside in every synergy we model. We make sure it's bankable. Here's where conviction meets discipline. We recommend an offer of $12.80 per share, or roughly $5.16 billion in equity value. That price falls between the peer-based valuation of $12.59 and a synergy-adjusted DCF of $13.43. We believe this represents a balanced range where Amazon captures meaningful upside without overpaying. This offer reflects CIPHER's current performance while also recognizing the additional value Amazon can create through synergies such as energy optimization, compute integration, and tax efficiency. For CIPHER shareholders, it represents a fair value and attractive premium. For Amazon, it's a disciplined use of capital that converts a volatile miner into a strategic infrastructure asset supporting future compute growth. We're not paying for what CIPHER is today. We are investing in what it can become under Amazon's scale and operational strength. At $12.80 per share and $5.16 billion in total, this is a fair and well-supported offer designed to deliver long-term value for both parties.